Imagine watching a chart where price barely moves, yet the tape suddenly comes alive. Volume surges, the spread tightens, and for a brief moment, you can almost hear the composite operator stepping in. This is the hidden battlefield Richard Wyckoff studied relentlessly, and it's the same battlefield where modern scalpers quietly take their money. In Wyckoff's world, volume is not noise, it's the operator's footprint, and when you know how to read it, you can scalp with near magical precision. Picture this: price dips into a micro support zone, prints a sharp down bar on ultra-high volume, yet closes in the upper half of the candle. To the untrained eye, it's just volatility. But to a Wyckoff trader, it's classic absorption, strong hands swallowing, weak hands selling. Seconds later, price snaps upward in a clean 0.20% burst, a perfect scalp if you knew what the volume was telling you. This volume-based Wyckoff scalping strategy is where the market finally reveals its secret language. And once you learn it, you'll never watch a chart the same way again. Ladies and gentlemen, traders and students of the market, today we step into the very heartbeat of price movement, the language of volume. Richard Wyckoff believed that if price is the body of the market, then volume is its voice, revealing the true intentions of the composite operator long before the crowd becomes aware. In the world of scalping, where decisions must be made in seconds and precision is everything, this principle becomes even more powerful. Most traders waste years chasing indicators that lag, signals that repaint, or strategies that collapse under pressure. But Wyckoff's approach has never needed gimmicks. It relies on reading what the market is actually doing. Who is buying, who is selling, and when strong hands quietly step in to shift the balance. This is why a volume-based Wyckoff scalping strategy feels almost magical. It aligns you with the real motives of the professionals controlling the tape. And once you learn to decode their footprints, the market stops being chaos and becomes a conversation, one you're finally prepared to answer with confidence. In the world of Wyckoff analysis, where every candle is a message and every volume bar is a confession, the volume climax reversal stands out as one of the most explosive and reliable signals for short-term scalpers. It represents the precise moment when the market's dominant force, the composite operator, steps in with overwhelming pressure, creating a turning point so sharp that price snaps back almost instantly. Scalpers who understand this phenomenon can capture rapid moves that unfold within seconds, long before the herd realizes what just happened. To understand a volume climax reversal, think of it as the market's pressure valve bursting. Price has been moving strongly in one direction, either a micro downtrend or a micro uptrend, fueled by retail emotions. Fear pushes weak holders to dump at the bottom, greed pushes them to chase at the top. But suddenly a massive surge in volume appears, far larger than anything in the recent structure. On the surface, this looks like continuation pressure. In reality, it's stopping volume, the signature move of large operators who are absorbing the final burst of emotional orders. Wyckoff taught that the market turns not when price hits a line, nor when an indicator flashes, but when the dominant professional side has finished their business. And nothing reveals that moment more clearly than a dramatic volume spike, followed by an immediate failure of price to continue in the same direction. Picture this scenario: the market has been declining for several minutes, printing a sequence of lower lows. Suddenly, a new low forms on a vertical wide down bar accompanied by extreme volume, double, even triple the surrounding bars. Retail traders panic and sell aggressively, yet the candle closes in the upper half of its range. This is the tell. Professionals stepped in, bought everything being dumped, and absorbed all available supply. Price tries to push lower again in the next bar, but fails dramatically. At that moment, you have a classic Wyckoff-style volume climax reversal, a high-probability scalp in the opposite direction. For scalpers, this pattern is gold. Why? because the move that follows is often fast and clean. Once strong hands step in forcefully, the imbalance they create causes price to spring upward, or downward, in the case of a buying climax. Retail participants, who just contributed to the climax, become the fuel for the reversal when their stops get triggered. The burst of liquidity creates slippage, momentum, and a narrow window for a sharp profit. However, a volume climax reversal is not just about spotting volume spikes. It requires reading the story of the candle. The spread, the close relative to the range, the reaction of the next bar, and the context of the preceding trend all matter. Wyckoff insisted that volume only has meaning when interpreted with price behavior. When both align, extreme volume plus failure to continue, you're witnessing the precise instant the composite operator flips the script. In short, the volume climax reversal is the scalper's closest equivalent to Wyckoff's famous change of character. A powerful shift in control that marks a tradable turning point. Master this signal and you'll understand why Wyckoff traders say volume doesn't lie. In Wyckoff's universe, there is no such thing as a random pause in price. Every hesitation, every stall, every moment of balance is a direct reflection of supply and demand wrestling for dominance. Nowhere is this more evident than in absorption at micro-support or resistance, a phenomenon that forms the backbone of Wyckoff's tape, reading logic and one of the most reliable scalping signals in modern markets. Absorption is the silent moment when the composite operator reveals their intentions, not through dramatic moves, but through patient, controlled pressure that stops the market dead in its tracks. To understand absorption, imagine price approaching a micro-support level during a rapid downtrend. Retail traders, driven by fear or automated strategies, slam the sell button. Logically, with so much selling pressure, price should break support and continue downward. Yet it doesn't. Instead, price hovers above the level, refusing to follow the expected path. Each successive test of support sees large volume hitting the tape, but price barely moves. This is the footprint of strong hands absorbing weak hands, panic-driven supply. Wyckoff taught that professionals do not chase price. They let the market come to them. When they want to accumulate, they welcome retail selling. When they want to distribute, they invite retail buying. Absorption is their way of quietly transferring ownership without disturbing price. It is the exact opposite of the emotional, frantic moves retail traders create. For scalpers, this behavior becomes a goldmine. When absorption occurs at micro levels, it creates a spring-like effect. Price compresses, supply gets eaten alive, and once the operators finish accumulation, price snaps upward with ferocity. The move that follows is often fast, clean, and highly profitable for quick intraday scalps. Picture this example: the market is declining toward a short-term support zone. A rapid down move approaches the level, volume increases sharply, and a wide candle forms. Retail traders assume a breakdown is inevitable, but instead of slicing through the level, price freezes. The next candle prints a small-bodied bar with long, lower wicks. Attempts to push lower are immediately bought up. Volume remains elevated, a classic Wyckoff sign of absorption. 2 or 3 candles later, you see a subtle shift. The spread narrows, the closes rise slightly, and the selling pressure visibly fails. This is the moment the composite operator reveals their hand. Shortly after, price springs upward in a sharp burst, a textbook Wyckoff scalp entry with high probability. Absorption is powerful because it tells you something indicators rarely tell you: the real intentions of the smart money. Indicators lag. Absorption is real time. Indicators react to the aftermath. Absorption is the cause. Scalpers who train their eyes to detect this subtle dance between volume and price gain a tremendous edge because they trade in alignment with the operators, not against them. Wyckoff famously said, "The market talks. All you must do is learn to listen." Absorption is the whisper before the breakout, the calm before the storm. Master it, and you'll catch moves the crowd never sees coming until it's too late. Richard Wyckoff built his entire trading philosophy around a single, revolutionary idea. The market is not a chaotic battlefield. It is an organized operation conducted by a dominant force he called the composite operator ZCO. This entity represents the combined actions of large institutions, syndicates, algorithms, and professional traders who control the majority of volume. To Wyckoff, following the composite operator was the only way to trade with consistency, and the key to following them lies in recognizing their footprints, subtle signatures they leave behind in price and volume. Understanding the composite operator is like learning to track an invisible giant walking through a forest. You may never see the giant itself, but the broken branches, deep footprints, and shifted soil tell you exactly where it has been and where it is going next. In trading, the CO's footprint shows up through abnormal volume, specific candle behavior, failed breakouts, failed breakdowns, and sudden changes in volatility. Scalpers who learn to identify these signals can ride the operator's moves with uncanny precision. Consider the simplest but most powerful CO footprint: effort versus result. Wyckoff taught that when volume as the effort increases dramatically but price barely moves as result, something major is happening beneath the surface. This is a clue that strong hands are absorbing, stepping into the market to either accumulate or distribute depending on context. For a scalper, this footprint often appears right before a sharp intraday reversal. Imagine price falling into a micro-support zone. A huge red candle prints with massive volume, retail panic selling. But instead of following through, the next candle shows a small body with long wicks. The effort was enormous, yet the result was minimal. That discrepancy is the unmistakable footprint of the composite operator absorbing supply. Seconds later, price snaps upward as soon as their absorption is complete. A scalper who recognizes this footprint can position themselves before the move begins, catching a clean, high-probability scalp. Another key CO footprint is fakeouts, strategic traps designed to mislead the crowd. When the market breaks above a micro-resistance level with a sudden volume spike but quickly collapses back below, it is often the composite operator triggering breakout buyers only to sell aggressively into their enthusiasm. The footprint is the rapid change in volume behavior, rising volume on the breakout, followed by even heavier volume on the reversal. For a Wyckoff scalper, this is a clear signal to enter short. But perhaps the most consistent footprint of all is the change of character, a sudden shift in volatility, spread, or volume that marks a transition from one phase to another. Wyckoff taught that the CO always signals their presence through a noticeable change in how the market behaves. When the tape becomes erratic after a period of smooth trend, or when small spreads suddenly expand, the CO is stepping in. In every case, the composite operator's footprint reveals intention. And once you learn to recognize these subtle clues, you are no longer guessing. You are following the invisible hand that guides the market itself. For scalpers, this is the closest thing to trading with X-ray vision. In Richard Wyckoff's world, the market is a battlefield of deception where professional operators use strategic maneuvers to mislead the crowd and take positions at the most favorable prices. Among these maneuvers, the high-volume trap bar HVTB stands as one of the most cunning and profitable signals a trader can learn to identify, especially in scalping. The HVB is not just a candle, it is a psychological ambush engineered by the composite operator to lure amateurs into the worst possible trade at the exact moment a reversal is being born. The high-volume trap bar occurs when price breaks above resistance or below support with a sudden surge in volume, creating the illusion of a genuine breakout. Retail traders, conditioned by breakout strategies, indicators, or raw emotion, think they are witnessing the beginning of a new trend leg. They rush in, convinced the market is about to run in their favor. But this is precisely when the trap snaps shut. The breakout fails almost instantly, price reverses sharply, and the volume bar spikes to extreme heights. This combination of fake breakouts of huge volume as fast reversal is the signature of an HVTB. Why does the composite operator engineer such moves? Because traps are efficient. They force liquidity to appear instantly. When the CO wants to distribute in a bullish environment, they need buyers to absorb their sell orders. What better way to attract buyers than a convincing breakout? When they want to accumulate at lower prices, they trigger selling by creating a false breakdown. In both cases, the trap bar acts as a liquidity magnet, drawing in emotional traders whose stops will later fuel the very move they are trying to trade. From a Wyckoff perspective, the HVTB represents a perfect example of effort with deceptive result. Huge volume appears because masses of traders are entering impulsively, yet price refuses to continue in the breakout direction. Wyckoff taught that when volume is high but progress fails, it exposes the presence of strong hands acting deliberately to counter the crowd. In scalping, this footprint becomes invaluable because the resulting reversal is often sharp, immediate, and highly tradable. Imagine this scenario. Price has tested a micro-resistance level several times. Each time it is rejected, until suddenly, a wide bullish candle rips through the level on massive volume. Retail breakout traders jump in, expecting continuation, but within the next 3 to 5 seconds, the candle begins to retreat. The close dips back below resistance. The next bar opens lower and pushes down hard. That breakout wasn't strength. It was distribution. The high-volume trap bar has appeared and the CO has sprung their trap. What follows is a fast downward move, often 0.20% to 0% within moments. A scalper who recognizes the HVTB can enter on the failure and catch the reversal while the crowd is still confused. The beauty of the HVTB lies in its reliability. Unlike indicators that repaint or lag, the trap bar is a real, time psychological event rooted in human behavior and institutional tactics. It reflects pure Wyckoff logic. Understand the motives of the professionals, and you will stop falling for the traps they set for the masses. In Richard Wyckoff's legendary market teachings, every movement in price boils down to a single foundational truth, the constant shift in supply and demand. But for scalpers, who operate in the fastest, most fragile layers of the market, understanding short-term supply-demand imbalances becomes the holy grail. These small, fleeting pockets of imbalance reveal where the composite operator is quietly engineering micro moves, stepping into the market with precision while retail traders remain unaware. When read correctly, these imbalances offer scalpers some of the highest probability entries available in any time frame. At its core, a short-term supply-demand imbalance occurs when one side, buyers or sellers, momentarily overwhelms the other. But Wyckoff teaches that imbalance does not appear randomly. It is the direct result of professional intentions. When strong hands want to accumulate, they remove supply from the market by absorbing every sell order until sellers are exhausted. When they want to distribute, they do the opposite, flooding the tape with hidden sell orders until demand dries up completely. For scalpers, the magic happens when these imbalances appear at micro-turning points. Imagine price grinding higher in a slow intraday uptrend. Suddenly, volume spikes, but the next candle closes weak. That is short-term demand exhaustion. Buyers have pushed as far as they can, but now their strength fails. At the same time, sellers begin stepping in more aggressively. That shift creates a micro-supply demand imbalance, often followed by a fast downward reaction. A scalper who spots this can position early, ride the imbalance, and exit with a clean profit before the broader market even realizes momentum has shifted. The opposite is equally powerful. Picture a sudden drop in price, sharp and emotional. Retail traders panic, but on the tape, you notice something. Although price falls quickly, the spreads begin to narrow and the volume remains high. This is short-term supply absorption. Strong hands are swallowing all incoming sell orders. When the selling finally dries up, the next candle prints a small, bodied bar with a higher low. That is the exact moment supply collapses and demand once again becomes dominant. The imbalance flips and price snaps upward. Scalpers who understand this dynamic can often catch the first candle of the reversal, the highest R moment in microstructural scalping. Wyckoff insisted that every imbalance must be judged in context. A demand imbalance at the top of a wide trading range is not strength, it's distribution. A supply imbalance at the bottom of a tight range isn't weakness, it's accumulation. This principle becomes even more critical in scalping, where moves are small but meaningful. Every candle tells a story, every surge or contraction in volume reflects a shift in power. One of the clearest signs of an impending imbalance is the change of behaviors, Kobe. When price has been moving smoothly and suddenly a candle appears with a drastically different spread, volume, or reaction, that's the composite operator adjusting the levels of supply and demand. The imbalance they create often becomes the trigger for the next micro move. Ultimately, mastering short-term supply-demand imbalances gives scalpers a decisive edge. You're no longer reacting to indicators or guessing based on patterns. You're reading the raw heartbeat of the market. Wyckoff said it best: the market reveals its intentions to the trained eye. And nowhere is that more true than in the tiny but powerful imbalances that shape intraday scalping signals. In the end, the brilliance of Richard Wyckoff's work lies in its timeless simplicity. The market is a living organism driven by supply, demand, and intention, and those who learn to read its footprints gain an advantage that no indicator can replicate. Whether it's the explosive signal of a volume climax reversal, the quiet strength of absorption at micro levels, the unmistakable composite operator footprint, the cunning deception of the high-volume trap bar, or the rapid shifts in short-term supply-demand imbalances, each element forms part of a unified language spoken only by the strongest players in the market. Most traders spend years trying to predict the market using complexity. Wyckoff teaches us the opposite. Trade what the market reveals, not what you hope for. Scalping becomes easier, faster, and more accurate when you stop fighting randomness and start listening to the true story told through price and volume. The composite operator doesn't hide as much as traders think. He simply expects you to pay attention. When you begin to recognize these signals in real time, the sudden exhaustion of supply, the strategic traps, the absorption at key levels, the imbalance shifts, the hidden accumulation, you stop trading like the crowd and start trading alongside the professionals who actually move the market. And that shift is what transforms a struggling trader into a precise, disciplined operator capable of capturing consistent, high-probability scalps. Wyckoff's wisdom is not magic, but to those who master it, it certainly feels that way, because once you learn to decode the market's intentions through volume, you stop guessing and start anticipating. And anticipation, not reaction, is the real foundation of trading success.